Morning, Lynn. How are you?
Good. How are you?
Very good. We're on a similar time zone for once.
Yeah, nice change of pace.
Nice change of pace.
How's the United States treating you?
Very well. Very well. Had a couple of good nights in Texas, and now I'm Worcester in Massachusetts. I'm about to leave, but I went to see a band called The Ghost Inside last night. So if you're into hardcore metal, which I imagine you're not, but if you're into hardcore metal, you'd enjoy it. But it was no, it was really good. I made a podcast series about this band called The Ghost Inside, and they had a bus crash a few years ago, and the driver was killed. The drummer lost his leg. It was
Oh,
awful,
geez.
yeah. And they took 4 years to come back, and they played LA, and then COVID hit, and then they basically didn't play again for another nearly 18 months. So it was,
Jeez.
yeah, but it was an emotional and good evening. Anyway, US
Sounds
is
like
treating
it.
me very well. Always does. Okay, so today's show. I get so many emails, Lynn, where people are saying you do a lot of pro Bitcoin shows. You do your shows with Willie where you talk about price. You know, it's all very pro. And then online, if anyone has any criticism, especially if they're outside of the Bitcoin community and known well, you can go in and it's essentially a pile of people telling them why they're wrong. But some people are saying, well, we should have a better and fairer debate about the criticisms of Bitcoin. So you and I agreed to do this. You ready for
Yeah,
this?
yeah. I think it's really, it's one of those things. Some people might not be their favorite episode, but I think it's an important topic to cover. I think we should. It's like one of those things. If you're on the Titanic and you think you're unsinkable, you're more likely to hit an iceberg. Whereas if you're on the Titanic and you still want to be looking out for icebergs, you still want to identify things that could conceivably mess up your ship, or at least delay your course or something like that. And so it is useful to be on the lookout for all the different risks that can happen.
I think the delay your course thing is important as well because I don't think most the things we're going to discuss today are things that would necessarily destroy Bitcoin, but they're things that you can be prepared for that might put a bump in the road. So I think these are all fair discussion points, and I think we should probably do a little bit more of this. I know myself, like before, I got a little bit swept up in tweeting out prices and having laser eyes and all those kind of things, and I think you perhaps lose a bit of objectivity.
Yeah, I think it's yeah. So one thing I think one way I was able to reach a lot of people when I first heard about Bitcoin was because prior to that, I was cautious on Bitcoin. I basically explained in 2017 why I'm not buying it. And then I, kept monitoring it. And then 2020, when I bought it, that had some weight to it for people that were following my work because they know that I saw information that changed my view on it. It wasn't bearish before, but it was kind of neutral. Like I wasn't convicted enough, and then I kind of was over that level where I was like, okay, now I'm convicted enough to purchase it. And so it is good to basically have sources that at least try to, everyone should try to be objective at least. We always have human biases, but we should try to identify those.
Well, some of the people I find most interesting are the money people who've changed their opinions. Someone like Ray Dalio, or even to some extent, someone like Jamie Dimon, when they've actually realised, they're on the wrong side of history here, and they've maybe made some assumptions, and they've gone back and reevaluated. I find those really valuable. What I find difficult is people's like Hanky and Schiff, who seem to become so embedded. Even Taleb, who we covered recently. Oh, by the way, how surreal was that having Snowden tweet out to support you?
That was like there was like that joke that Domino's meme where like we went on your show to just talk about a paper, a Bitcoin show to talk about a Bitcoin paper, and then just the whole cucumbers and Snowden, and it just kind of it blew up from there.
But yeah, anyway, just going back to that. I mean, anyways, look, this is important stuff we're going to cover today. And yeah, I enjoy covering it. I've questioned myself a lot recently with this. I've questioned whether I've become a cheerleader. I think of something like El Salvador, which is an amazing project. It's an exciting project, but it doesn't come with it doesn't come without risks itself, and it can come to risks to individuals who don't have a lot of money who might buy into this project. So I think it's valuable stuff, and we're going to kick off by talking about governments, bans by governments. But I just remembered I did an interview with Saifedean, God, 2.5 years ago, and he said the biggest risk to Bitcoin is good government policy.
Yeah, pretty much because we're contrasting Bitcoin with their currencies. So
Yeah.
that's what I imagine that the direction that argument went was.
Yeah, that's the exact argument. But we know we're not going to have good government policy. So we're going to talk initially about bans by major governments, and we have had bans. We've had the the confusing China ban, which seems to keep happening. Seem to keep on cracking down on it by I'm not sure what there is left to crack down. I've been to Bolivia. I think it's banned there. I think it's banned in Pakistan. I can't remember everywhere else. Conversely, we do have the El Salvador situation and also other South and Central American countries looking positive. But um, bans by a major government, I guess you are thinking, well, the biggest risk would be a ban by the US government because they tend to lead the world. But maybe some kind of ban, coordinated ban across the EU. I think they're the two that concern me most.
Yeah, because those are very big pools of capital. And so, when a smaller country bans it, or even a large country that doesn't have a lot of financial weight, like for example, Nigeria is a very large country. They've banned it from their financial system at least. But the United States and Europe are the two kind of 800-pound gorillas that could at least for the a period of time probably affect price notably if they were to ban it. And it's worth there's a couple different types of ban. So one, it's really hard to have any sort of enforceable ban where you say people are just not allowed to own it under penalty of jail, right? So they did that. I mean, the Americans did that for gold for like 40 years, from the mid 1930s to the mid 1970s. It's kind of remarkable, the land of the free, and you literally couldn't own a benign metal, just a yellow metal. And so you could conceivably have one of those for Bitcoin, but it's harder, right? Because it's hard to prove someone has it. If you are required to turn it in, you could just you could destroy your hardware wallet, for example. And how do they know whether or not you have a backup? It's basically it's the technology is better for making it hard to confiscate and prove that someone still has access to it. Kind of that classic boating accident meme that is hard, so it's harder than gold. And so a lot of countries haven't necessarily tried that route. I mean, even China, as authoritarian as they are, I think they've seen that that's not a clean way to go. And so the easier way for them to do it is to say, okay, we're not going to go after the consumer level to say you can't own it, and we're not going to try to enforce that. Instead, we're going to sever it from our banking system and ban industrial scale mining. So what that does is you basically go after the fiat on-ramps, right? So you go after a handful of major companies. Those are easy to track, easy to stop, very easy to enforce. And then also any sort of large mining operations you can generally identify and cut them off. And so basically, Nigeria has done this as well, where they say it's not illegal to own Bitcoin, but banks can't send money into Bitcoin exchanges. And so you still have a vibrant peer-to-peer trading community in Nigeria, and they can still receive Bitcoin from, say, foreign sources, right? So if a Nigerian does graphic design for someone, and then they get paid in Bitcoin by an international source or a domestic source, I mean that's still totally doable. They can send Bitcoin out if they, there was that article in the Guardian where there are protesters, the government cracked down and froze their bank accounts, so they're using Bitcoin. There are merchants that were just trying to do their job and they had capital control, so they were able to use Bitcoin. So that's still possible, but it can slow down adoption if you were to get something like that in the United States or Europe, where they say these big giant multi-trillion-dollar economies, the on ramps are severed.
Yeah,
And
and I think
what's
so. Sorry to interrupt you. I was just going to say an interesting different point for Nigeria is, and I know this is prevalent throughout Africa, is the idea of these money changers. We also had when I was in Venezuela, these kind of street vendors for that are money changers. It's not really the kind of thing you have in the US or the UK. We have bureau de changes in the UK, but that really is like a regulated business. We don't tend to have people who stand on the street converting currencies for people in cash. Um, it would be interesting to see if that kind of ban came up, whether you would see that in the US or Europe.
I think you'd see some of it. I mean, there would be a number of people that still want to buy Bitcoin, and so they would find ways. It just makes it so that, if you make it so that institutions can't own Bitcoin, if you make it so that, part of why Bitcoin has exploded is because the user interface has gotten better. It's gotten more easy to access it, and so that would be essentially a step back, right? So that would increase the hurdle of being able to get it, make it a step harder to get it. And so we should expect that could conceivably slow it down. Now, it depends on the reason for the ban, because if the currency is falling apart and then they ban it, that people are going to find a way anyway, right? So it's one of those things where generally countries that block alternative types of money like gold or Bitcoin, that's generally when you want to own something like gold or Bitcoin. And so, if the United States, for example, that 40-year period where we banned gold, if you look at a chart of 10-year Treasury returns over inflation, and it's kind of the annualized return from buying and holding a 10-year Treasury till maturity. It's been most of the last, say, 150 years positive, meaning you earned interest, it was higher than inflation. But there was a really big period, it was about 40 years, where it was negative. And that ban on gold perfectly overlaps with that period, right? So when treasuries were not good investments, gold was banned. And so, and it was, and even that, gold, it was actually really hard to enforce that ban. There were very steep penalties if you were caught, but there was very very few prosecutions, and they didn't go to door to door to get it. And so there were a lot of entities that, as far as people can tell, just hodled their gold through that entire period, and that's just how it went out. So I think with Bitcoin, you'd have a similar phenomenon where, again, it's really hard to ban on the consumer level, even harder than gold, I would argue. You're essentially banning math or encryption or the ability to memorize a number in your head. Hard to prove someone has it. Um, and so it's really my view about the fiat on ramps and the institutions and those large pools of capital that are, if you want to see number go up, right, then and market cap go up, eventually those large pools of capital have to get into it. And so if they're severed from doing it, that can slow down adoption, unless things get bad enough that it's a crisis of confidence and people flock to it. So it's kind of like it could slow it, but it also could be a sign that things really are going well with the currency. If you were to see those major rule of law countries kind of ban that.
Well, we should consider the different types of risks, because we've said the risks here to Bitcoin, because there's risk like cataclysmic risk which destroy Bitcoin's use case and pushes it down towards zero. There's risks of slowing adoption, and there's price risks. And I think all of these things we're going to talk about have varying effects on each. I don't see a ban on Bitcoin by certain governments as being a risk to it destroying Bitcoin, but I do certainly see slowness of adoption and a price risk to investors. One of the things that seems to be happening is I almost think we're past that point as well, Lyn. We may see other smaller countries ban it, but I think we're kind of past that point as we have other countries accepting it and considering legislation to make it legal, so as we have in El Salvador, but also Cuba, I think, is passing through legislation at the moment as well. And I've also think we've seen in the US that there is enough weight within senators. There's enough senators now who are starting to show an interest. We know we have Senator Lummis, but also Ted Cruz recently. I know certain people are working on forming an SPAC, which is not something I fully understand because I'm not American, but forming an SPAC to actually, as I understand it, that is to put people to run against those who may be against Bitcoin. So Bitcoiners have some power now. They have some weight. So, and also even with the infrastructure bill itself, Lyn, that felt like more of an acceptance of Bitcoin. Like there's a benefit. And if the US was to ban Bitcoin, it would destroy a lot of US wealth and quite a considerable part of the economy.
This is something I've argued in some of my pieces, where people tend to say if it gets too big, governments will ban it, whereas I tend to say the opposite. The bigger it gets, the more resistant it gets to banning, because the donor class ends up owning it, politicians end up owning it, and it becomes a very large pool of capital to influence politics, and that you don't want to destroy hundreds of billions of dollars of American wealth is stored in Bitcoin, and
Yeah.
probably at least 100 billion European wealth, maybe 200 billion. I'm not sure the exact numbers, but there's a large amount of money there. And also, when you start looking at polls by places like NIDIG and stuff, I mean, a meaningful percentage of the population in some of these countries is beginning to own it. And so, especially if it can go a few more years and reach a little bit higher adoption, that starts becoming, you start to get negative dividends politically if you go after it, and if you sound like you don't understand it. And so I think that they're starting to realize that. And the interesting thing about this recent like infrastructure bill, so yeah, they didn't know what they were doing, so they wanted to raise funding for the bill, and so they said, okay, let's step up enforcement for taxes, because that's one way that they can raise tax revenue, is to say we're not going to do a new tax, but we're going to try to get better enforcement of an existing tax. So that's what they were trying to do, but they didn't understand the technology enough to write that properly. And so it had this big ambiguity that you can almost say like it basically there's an unreasonable tax policy on basically anyone using it, essentially miners, things like that, that they literally can't do. And then so the question is, well, does that kind of by extension make them illegal to run because they just can't file the it's kind of this big like bureaucratic mess. But then there are a number of politicians that understood the technology better, or at least had the had the ear of someone that understood it better. And the interesting was that was a bipartisan push, right? So you had some of the well-known Bitcoiners in Congress that were on top of that, but then you also had other faces that were not previously familiar, from both sides, saying like, wait a second, this is poorly worded. We need to make sure this is sorted out because of course we want people to pay their legal taxes, but we don't want to write this stupidly so that the innovation goes elsewhere. And so there was a wake up call, I think.
Well, we're seeing that in Europe. I mean, I think the US is fairly pro Bitcoin compared to Europe, especially UK, where I'm from. We have a very small Bitcoin scene in the UK, something I'm not even that part of. I spend most of my time here out in the US working with US people because it is more pro Bitcoin. We're also seeing it with various discussions across the EU. So I actually find the US more pro Bitcoin than Europe, but I'm kind of with you now. Whilst it is a risk, and it could be a risk, and I actually think it's starting to look like we're beyond that point. And certainly if Bitcoin does another 5 years without some huge regulatory oversight, which becomes almost catastrophic to adoption and growth, I think the wealth that exists within Bitcoin is something that could not be ignored by senators. And then the Bitcoiners have the power. The ironic being that a lot of Bitcoiners are kind of like anti-state, but will have the power to leverage their Bitcoin to have some kind of political influence.
Pretty much, yeah. Yeah, the bigger it gets, the harder it gets to deal with in my view. And it's hard to say if we're really kind of fully past the event horizon. I think we pretty much are. One thing to keep in mind is that central banks do talk to each other. They have the Bank for International Settlement. They basically have a lot of coordination. And so you could kind of see a last-ditch effort to sever it from the banking system across multiple countries if something was really going wrong in their countries. Ironically, they would blame Bitcoin for things like their currency not starting to fail. For example, if people get tired of persistently negative real rates, they start to get out of the currency, and you start to get currency issues. They could, as a last-ditch effort, blame Bitcoin. And so I wouldn't say we're fully out of the woods, but at this point, you have reached, in my view, at least in the United States, some sort of critical mass where you have enough donors and politicians and things like that, where it's really, in any sort of rule of law country, it's really hard to outright ban it.
I think with these things as well, it's the consideration. If this is a risk, it's what's to be done. But I was really impressed with how people in the Bitcoin community came together and actually realized, look, we need to work together on this. Some lobbying efforts, phone your senator, or is it phone your congressman, or but yeah, I think people are starting to realize, yes, this is a risk, and perhaps rather than being outside of the system, we have to work perhaps a little bit within the system to protect us against this risk. A little bit similar to how Saylor approached the mining and energy fund. He took a lot of criticism at the time, me included. But actually, in some ways, if you can fight off these attacks, I think it's a good thing. So, okay, that's bans by major governments. The next thing we were going to talk about is a major bug, which we know has happened in Bitcoin. There was a massive inflation bug at one point. It is a risk, and there are different types of bugs. I think the biggest risk is some kind of consensus bug that leads to a chain split, and how that's dealt with. It's always a risk. I've done a few interviews with various people who work on core and talked about the process they go through for code reviews, but code can have bugs, so it's a non-zero risk. What have you looked into with this?
Yeah, I mean, so at the end of the day, we're running distributed software to come to a consensus on a blockchain. And so if there are bugs that interfere with our ability to do that, it can threaten kind of the obviously the near term functioning while it's happening, but then longer term it can affect the perception of safety, and its usefulness as money, if you were to get major ones of those or too many of those. And so Bitcoin, actually this is in the news because
Yeah.
Ethereum just recently had a chain split, and that's not the first time. And it's one of those things too where users were basically 75% of nodes supposedly run this one type of node software, and they were told that there's a security issue they have to update, So they update and there's a chain split because there's a bug in that. And so it also kind of threatens the self-sovereignty of the nodes, where you're basically saying, I recognize Ethereum, let's say, as the node I'm running. But then if someone says actually your thing has a critical bug, you have to update. That kind of affects your self-sovereignty. And so if we look at Bitcoin, it had an inflation bug in 2010 that Satoshi fixed. In 2013, there was an unintended chain split from an upgrade. But back then, Bitcoin was a much smaller asset than Ethereum is now. I mean, it was like 4 years old, is very small, whereas Ethereum is like 6 years old, and it's hundreds of billions of dollars. Like they should be past the point where that happens regularly. But so far, Bitcoin has had a better track record, in part because security is like the number one thing in the Bitcoin culture. They want to keep the code simple. They want to be super slow and cautious and achieve massive consensus before doing updates. But that doesn't rule the possibility out. I mean, there's actually been, besides those two incidents, I mean, there were like issues in 2018 that required, kind of node updates to resolve. If you look at the kind of the list of issues that have occurred, it's actually a reasonably long list, but they've just been handled better so far in the Bitcoin community. So it's my view, by far the most rock solid blockchain in terms of how well it's designed, the culture around maintaining it, being cautious with it. But we can't rule out the possibility of unintended chain splits, or we find out that our existing node is somehow compromised, and that we have to upgrade to something. And so those types of risks are present, and especially as you're building out what many people view as eventually being like a global reserve currency, a currency based on energy, this international store of value medium of exchange. You want that to be as rock solid as possible, and not to have things kind of hurt the brand. So back in 2013, when Bitcoin had that chain split, its price did go down. It's funny because Ethereum just had the chain split, the price didn't go down. It's because they don't care about security. Whereas, with Bitcoin, the risk is that because Bitcoin is known as the secure one, you really don't want a major security bug or something like that, because that does kind of, in my view, threaten the value proposition. So long run, we want to see this kind of their continued very cautious approach. And it also, whenever this happens with Ethereum, we're reminded why Bitcoin is designed the way it is, where it's meant to be non-buggy as possible and as clean and elegant as possible.
Well, that's why I found this recent narrative around Ethereum as ultrasound money so disingenuous. I can't figure out if it's a troll or they actually believe it themselves. I think some people do, but I found it so disingenuous because I think if you're going to have something, you're going to call something ultrasound money, it has to be built on a solid foundation, and that's what Bitcoin does have. Bitcoin has the most solid foundation on this base layer, whereas something like Ethereum doesn't have the most solid foundation because it is so complex. There is so much to it. So I've always found that a bit disingenuous. But if anyone is listening and they're thinking, well, what can we do about this? I think the best thing people can do is, especially if you hold a good amount of Bitcoin, or if you just made some good gains, I think it's on all of us in a voluntary way to make contributions towards open source dev. I know you do. I do. It's not a huge amount, but it's still a relevant amount. All that money that goes to Chaincode or Brink or even the Human Rights Foundation, that is helping beef up the developers, the number of developers we have. And it's been great to see some of the exchanges, even Coinbase and the Winklevoss and various other exchanges start to contribute towards this. But I think that is something that's on all of us to do.
I agree, because there are some projects that can be done with normal investors because they have a reason to be profitable eventually, but there are other things that just are not going to be inherently profitable, like maintaining the core code, or adding privacy features maybe, right? So that's kind of like Human Rights Foundation stuff, where they want to boost privacy. There's maybe less money in that, and so those types of things, it really is good to donate to basically give back to help solidify this, what is currently almost $1 trillion asset. And basically, you want to minimize the risk of bugs and issues like that, and advance the development in a slow and cautious way as much as possible.
Okay, the next thing we're going to talk about is quantum computing, which is something I have covered in the past, but I'm a couple of years out and people are asking me to cover it again. I've got a feeling the conversation will be very similar, though. There's not a reason not to do it, but quantum computing. we know that the promise of quantum computing could be catastrophic to Bitcoin. But the conversation I had last time was that we're not there yet, and we might never get there with quantum computing. We may never get to a point where people are able to build usable quantum computing, quantum computers that can actually. I mean, what is it? What is it with the quantum computer? The risk is that it can break the SHA-256 hash.
Yeah, and I think I'm not a encryption expert
No, me
nor
neither.
a quantum computing expert, but I have looked into it pretty deeply. And my understanding is that you can't just unravel all of Bitcoin with it, but you could conceivably if you find a public key, you could then derive the private key associated with that public key. So you could start breaking individual addresses, which is different than just kind of like turning off the light switch and Bitcoin's just messed up. But of course, that's obviously a major security threat. It affects the usefulness of Bitcoin as money. And so, I mean, there are also, going back to the probability, right? So a lot of people take it for granted that we're going to have quantum computing. And technology is not one of those guaranteed straight line things. I mean, we're not promised quantum computing. We're not promised cold fusion. We're not promised to be a spacefaring species. We don't know how some of these technologies are going to develop. And so, for example, if you look back at aerospace technology, I mean, people in the 80s thought we'd be like in flying cars by now, and that we'd be like on Mars. And if anything, we've kind of taken a step back in terms of our aerospace abilities. I mean, our fastest commercial jets now are slower than they were. The fastest ones 40 years ago. Our military jets are slower. So we've advanced a lot in some areas, but we've kind of stagnated in other areas. And so some things end up just being very challenging. And so one is, we don't know how far away that is. We don't know, other than it still seems pretty far. And then two, there are, known ways, or at least kind of developed ways to make, upgrade Bitcoin so that it becomes more quantum hard. And the risk is that, that it could require action by addresses to maybe move to another address or something like that. I've seen that, put out, that probably people that understand the encryption better than I can explain that. And so I've seen, for example, arguments that, Satoshi's original coins might eventually be taken by quantum computing, is because he probably would never, even if he's capable of doing it, probably wouldn't upgrade to another address location, for example. So, we'll see how this plays out, but I consider it a very low and long-term risk, similar to how if I'm analyzing an energy stock, for example, an oil stock, I have to sit there and say, well, what if they develop cold fusion in the next 5 years? It's not something that it's firmly on, something you can really do something about, other than be aware that technology can change over time. We can get new energy sources, and so similar, we have to be on the lookout maybe for quantum computing, but I don't consider it like a make or break thing. This is something that people will probably be prepared for. So the only major surprise would be if someone somehow develops cloud computing in secret and then starts launching it at Bitcoin. But also, I mean, it's also worth pointing out that
Sorry,
if that's your
you said cloud there. You meant quantum.
oh yes, quantum computing, and then attacks Bitcoin in
Mm.
secret from that. And that's also worth pointing out that it's not just Bitcoin that would be at risk. Our entire, banking system, brokerage system, everything we do is pretty much based on encryption working.
Well, the entire
Um,
internet.
yeah. And so, Bitcoin would be one of many concerns at that point. It's not like, oh, you should buy stock instead of Bitcoin in case there's quantum computing breakthroughs. It's like, no, you pretty much want to own guns and gold and food, and
Pink
if that
pineapple.
kind, yeah. So it's one of those things where we want it on our radar. We want, that's another, you probably want developers thinking about that over time, to eventually find updates to do that in the cleanest way possible if that starts to become a more legitimate threat.
Okay, next we're going to talk about a significant exchange hack. So obviously back in, I think it was 2013, was the Mt. Gox hack, which was it 2013 or 12? I can't remember, but it was a catastrophic moment for Bitcoin. And I know many people I spoke to at the time said they felt like this might be the end of Bitcoin. 800 odd thousand Bitcoin was stolen. I think we do have some PTSD from there. But at the same time, a lot of solid Bitcoiners are stand by what Andreas said, is not your keys, not your Bitcoin, encouraging people to self-custody. At the same time, with the mass influx of new Bitcoiners and also institutions, we know many of them are having their coins custody for them with the likes of Fidelity. I think Coinbase custody over it's over 1 million Bitcoin now. I can't remember their numbers. I don't know how many Fidelity have. Again, I don't see this as catastrophic. If it happened, it wouldn't be great. We probably would go through a very similar price crash scenario that we had in 2013 with Mt. Gox. But what I do see it would potentially do is reduce the confidence of people. And also, you could link that back to our first point. That could potentially become another attack vector for regulators, believing that this is not now a safe asset. At the same time, I look at the likes of Coinbase, and I have a huge amount of confidence in them that they have procedures in place that kind of can prevent these scenarios. But who knows, right?
Yeah, but I think you described it well. So we still have, I mean, exchange hacks still happen regularly, unfortunately. But at least, they're not currently these huge ones that own large percentage of Bitcoin. And that's, because the industry's grown so much since the Mt. Gox days. These large custodians have tens of billions of dollars worth of Bitcoin stored in them. They use extremely sophisticated methods to protect that, and so that the risk is very low. But yeah, if something like a Fidelity or a Coinbase just was like depleted of its coins, that would be like you point out, that wouldn't kill Bitcoin, but that could slow adoption. And so it's one of those things where if you look at, I believe Grayscale uses Coinbase custody, right? So it's a very, there's a very large amount of people, for example, reliant on a handful of these centralized institutions to hold their coins. And so obviously the one defense against that is to hold your own keys. But not everybody is technically suitable for that, right? So if my mom were to buy Bitcoin, she's probably not going to set up a multi-signature solution, have metal backups. She's going to just hold it with some institution that she trusts, kind of like her bank. And so there is a market for that. It's an important market for custodians. And so we want the user interface to be attractive. We want it to be easily accessible, so that that's part of what makes adoption go higher. I mean, I remember back when it was new, Bitcoin, and I was very busy back then, and just kind of, I had a lot on my plate. And every time I would just think of Bitcoin, I would kind of just the UI just wasn't there yet. So it's kind of like I would kind of like, maybe I should, open an account on one of these exchanges and try it out. And I was just like, it looks sketchy. I don't know. So like I just never got past that point to actually put an hour into it and kind of figure it out. And so it's gotten to that point where it's gotten a lot easier for people to access. But yeah, you would shake people's confidence. You would bring on regulators probably if you were to have one of these enormous kind of whale institutions go down. And so it is something to be aware of, because you could wake up one morning and just see the price down 20% because some crazy thing happened like that. And so that certainly affects people that are, involved with leverage in any way, right? It's not something I generally recommend. But if you're a hodler, that shouldn't be kind of a catastrophic outcome. But it certainly is a price and adoption affected thing, and a regulator thing.
Well, and the things people could do is just learn about custody in themselves. Consider multi-sig. There's a couple of good solutions out there. One of them's my sponsor, Casa. They have a very nice and clean interface for custody in your Bitcoin with a multi-sig wallet. But also I think Unchained also have one, but I think theirs is a little bit more focused on corporate clients. But I think that transition, it's a message we need to keep pushing. There are some other complications around it, in that we do have the borrowing and lending services. Again, one of my sponsors, BlockFi, and there's a few others out there, Leden, and I can't remember the other big one. But you can't custody the Bitcoin to use those services. And I know there's some talk around other ones which are multi-sig, and perhaps they own one key, etc. But there is that thing that we do need to keep pushing the education. People do need to spend the time looking at this. I guess the complication with something like Casa is that you really want their 3 or 5, but you have to have a certain amount of Bitcoin. So if your first Bitcoin purchase is $1,000, you're not going to be buying a $1,500 service. So I just think we need to keep pushing the message, Lyn.
Yeah, that's how I view it. And it's one of those things where I think you've even had guests to describe this, is that some of these, like the hacks, for example, the Mt. Gox hacks end up kind of showing Bitcoin's anti-fragile aspect, because that is what led to kind of the acceleration of development of things like hardware wallets, and easier ways to self-custody. It might have been Parker you had on the show that said that, but there's a lot of people that pointed that out, that Bitcoin's anti-fragility nature is that when something attacks it, generally the next year you'll see a bunch of responses to that attack, right?
Well, it's the immune system coming back.
Exactly. And so that's part of the whole kind of self-custody narrative, part of what makes Bitcoin different than gold and more resistant to centralization or confiscation than gold is that ability to self-custody it even in large amounts, as long as you use increasingly, sophisticated ways of doing that, which is hard to do with gold at large amounts. And so the having a culture based around doing that and educating people to do that is important, because that's what makes Bitcoin overall more resilient, but then more importantly protects them personally from a counterparty risk associated with an exchange going down.
Right. The next thing we're going to talk about is something you've dug quite deeply into recently. I'm not going to pretend I understand this fully. I'll ask you the questions based on what I understand and I don't understand. But we're going to talk about this long-term transition towards fees. This is something that comes up quite a bit. I've received quite a few emails. People asking me, "What about the transition to fees? What happens when the block subsidies, not gone because that's 2140. We'll all be long gone ourselves, but as it reduces. So I know you've looked into this. You did quite a bit of a deep dive. I'll put the link in the show notes, and I think I'll try and link to some of the Twitter discussions that happened around it. But can you just tell me about the research you did here?
Yeah, so eventually, people often ask what happens when all the coins are mined because they assume that miners just kind of go out of business, but that's not the case because there's also transaction fees. And they've been there since the beginning, but in the beginning they were a very small percentage because blocks weren't even full. So once Bitcoin got big enough where it could reliably fill blocks, you started to get a more reliable fee market. But even that does vary considerably, right? So obviously fees earlier this year during the $60,000 bull market were very big compared to what they were during the bear market portion. And so, over time, especially as we get into say the 2030s, the block subsidy will be small enough that the protocol will be more reliant on those fees paying miners. And it's one of those things where this is how adoption can affect security because the bigger Bitcoin gets, while that block size is still tight, means that those blocks are more reliably full. Fees are pretty high in the base chain, and so that can keep security up long term.
Sorry, just before we jump into that, should we just explain to because some people won't understand how Bitcoin derives its security and why this is important, how the role of miners, etc. So should we explain that?
Yeah, so that's actually a really good point because part of why Bitcoin's network effect is so strong is because it has the highest security. And then the more adoption it attracts, the stronger that security gets. And so basically, with any kind of proof of work blockchain, you have a bunch of miners that are working to, find the next block, which grants them coins, which is pre-programmed to decrease every 4 years, the number of coins they get per block. That's the declining block subsidy, as well as any transaction fees that people are willing to pay to make sure that their transaction is towards the front of the line to get in that block. And so, you know, the larger amount of miners backing that up makes it a much higher hurdle rate for anyone trying to do a 51% attack. And it's actually more risky. So Bitcoin's advantage is that in addition to it being the biggest cryptocurrency, it's by far the biggest proof of work, cryptocurrency, especially using the algorithm that it does. And so this is a risk for chains that are using the same proof of work algorithm as a bigger coin. So for example, Bitcoin Cash, Bitcoin Satoshi Vision, Ethereum Classic, these tend to be very vulnerable to 51% attacks because it only takes a percentage of that larger coin's miners to go after that smaller one. And so, for example, if 1% of Bitcoin miners are bored, they can go after Bitcoin SV and do a 51% attack and then go back to mining Bitcoin. And so that's why security is important. That's why Bitcoin and Bitcoin Cash are not the same, right? You don't have the same security assurances associated with them. And that's why many people view Bitcoin as money, but they don't view these other derivatives as money because they have far less security, far less hash rate, far higher probability of 51% attacks occurring. And so over the long run, the question becomes, will transaction fees be enough to make 51% attacks rare or impossible? And how do we adjust with that? And so I think, the short answer, I've done all kind of this math associated with it to see how it's scaled historically, how it could conceivably scale in the future based on a couple different outcomes. We can kind of model it like a matrix, right? So how big does Bitcoin get? What is the, say, the percentage of market cap or the percentage of annual transaction volume that is, takes place as fees, and is that enough to sustain it long term? And the answer is that as long as Bitcoin continues to grow, the answer is that it should be able to sustain itself. It should be able to generate multiple billions of dollars worth of fees per year, and that creates a pretty high hurdle rate for anyone to go after. And the challenging thing is that there's no proof of how much security is appropriate. It's one of those things that so far has been secured in practice, but not necessarily in theory, where we can walk through the steps it would take to do a 51% attack. I mean, you have to acquire 51% of the hardware, which is now very geographically distributed. And then you'd have to channel electricity of a small country basically into it and start trying to do 51% attacks. And even then, even if you're successful with a 51% attack, you don't kill that chain, right? So I mean, those other tokens that have been attacked, they're still around. It just
Well, and I
means that
also, sorry to interrupt. When I spoke to, I think it was Harry Suddock, when we talked about mining, he said actually it's more than 51% you need to be able to maintain an attack. So you have to be able to create the attack, you have to be able to maintain it. And he said that's also quite difficult. So I can't remember the number he gave to me, but a successful long-term 51% attack requires, I think, did he say 70%? I'll have to check. I'll try and check it, but people can listen to that show. But you actually need more than that.
it's not a Boolean outcome. The higher hash rate you have, the better chance you have of that working. And so yeah, probably you can do math on it to find out when it becomes probable. And so you want the barrier to having that be done very, very high, ideally. And then you want it high compared to the percent, but the potential gains they could get from doing so. So for example, an entity could short Bitcoin and then do a 51% attack and try to recoup their costs or make a gain from it. And so, you want that hurdle rate to be pretty high. Now, if it were to happen, that wouldn't be the end of Bitcoin, right? Because then that changes how you interact with it. That changes basically maybe the number of confirmation times we wait in order to consider a transaction to be secure. It doesn't affect your older transactions. It's not like they can rewrite the code just because they do a 51% attack. But basically, they can do various kind of, they can do obviously a double spend attack. There's also kind of interference they can play with the functioning of the transactions being processed. And so I think the way I view this risk is that it's a legitimate long-term concern that you want to watch. You want to see Bitcoin continue to grow. You want to see it maintain a healthy fee market. And that's also one reason why adoption and security are kind of interlinked, because if you do a number of attacks, so let's go back to for example, our government ban example, where let's say you do the kind where you just cut it off from the financial system. So you don't ban it outright. You don't get super authoritarian, but you say, okay, banks can't interface with it in the United States and Europe. Institutions can't own it. We don't have industrial scale miners in those countries, right? If that were to be successful at slowing down adoption, and let's say you keep Bitcoin under $1 trillion market cap for many years, as the block subsidy declines, well, then the overall miner revenue, starts to get weaker, and it starts to somewhat open the door if, say, a state actor like China wants to say, we don't like the fact that this permissionless money exists, and we want to try to discredit it or attack it. And so it becomes at that point more conceivable, still very challenging, but more conceivable that they could, potentially start attacking it, and then that could damage the brand, right? So that could damage how secure we view it, how suitable we view it as money. And so generally, you want to see that I would describe it as critical mass be reached and surpassed, where Bitcoin is large enough and flourishing enough that its blocks are always full, that miner revenue is very, very healthy from the fee portion, so that attacking it becomes exceedingly improbable. And it's something that it's the way it's designed looks suitable. I think it's going to make that transition well, but it does require Bitcoin being, well adopted, in my view.
And do you know what? Bitcoin has continued to survive every 4 years, and we've conceded. Whilst hash power has fluctuated, it has it has continued to rise, and it's really like this thing where I think about the beauty of the design, and I don't know how much was intentional or unintentional, but the halving and the design seems to have created this kind of like feedback loop every 4 years to increase the hash power. What I think would be interesting is if, when you talk about, in the future, maybe China wanted to attack it, but if a certain amount of wealth was held in the US and perhaps the US was very pro Bitcoin, whether you would there this would then become a national security risk for certain countries, and they would therefore want to load up on hash power to defend the network. And
Yeah.
I think it's the kind of thing that I think Jason Lowry, the Space Force guy who came out publicly recently, was saying that the future wars could be hash wars, which I find fascinating. I don't know if you've seen what he's been writing about.
Yeah, I've seen that come up. And yeah, basically, once it becomes that large, one is you have large custodians want to defend it, and you have countries wanting to defend it, while you have another country, maybe try to attack it. And that's why you want generally Bitcoin to achieve a certain level of adoption before the block subsidy gets really small, because you want it to achieve that critical mass where there's a lot of parties interested in defending it. You could even kind of conceive of like a science fiction war where we do a drone strike on someone else's hash rate because let's say China wants to attack it and we just do a drone strike on that little operation, and just say nope, you can't do that because you're attacking our money. Um, and so you wanted to achieve a certain level of escape velocity before that block subsidy gets too small. And like you, I mean, the thing that always astounds me about Bitcoin is how well designed it is, right? So
Mm,
that's the classic thing. People, they get into Bitcoin, they say, I'm new to Bitcoin. I'm here to help it and change it and make it
fix
better.
it.
And it's like
Mm,
it's remarkably how well Satoshi designed it. And so we're all kind of living in Satoshi's story, and we're watching this play out. People have obviously upgraded the protocol over time very gradually whenever there's kind of almost unanimous consensus. And it's just kind of amazing to watch over time how many things he really nailed, right? Because
mm.
it's really rare for a prototype to succeed on the first try. And in some ways, it wasn't the first try because
No, it wasn't.
yeah,
Yeah, he
yeah,
built on the shoulders of giants.
yeah. But even then, I mean, if you kind of do a lot of research, you have all these parts and you put them together. He made so many choices that 12 years later we're still marveling at the choices, the combination, the distribution pattern he took, all these kind of intricate details, even the decision to put in a block size cap, right? Things like that are, there's so many things. There's like one or two things could be different, and the project could have failed to take off for one reason or another. And so it's actually really remarkable how many things he got right. And this, the last thing we're kind of watching is okay. So will it get big enough for fees to be workable for security? In my view, would be yes, but it's something we have to monitor.
Well, and not just Satoshi. I mean, it's right to give him credit, but I think we need to also give credit to a lot of the people who fought on the front lines of Bitcoin, who've defended it, especially during the block size wars. I think what's happening with ETH is a good lens for that, working on ETH version 2, which has been coming forever, has a lot of criticism around it. Will it work? Won't it work? Will there be an ETH3, ETH4? I don't believe we will ever have a Bitcoin version 2. Yes, I know we have versions of the node software, but I don't believe we'll ever actually have to have a complete system redesign, which ETH has had to have. So I'm with you. I think it's absolutely fascinating and it's beautifully designed. The one thing I did want to just ask you about with the fee work you did, again, I'll put it in the show notes so people can read it, but it wasn't universally received as perfect analysis. You had was it Shinobi was critical? What was the criticism that came in for it?
Oh yeah, so I had a debate with Shinobi and someone else on Twitter, and so that comes down to ways to characterize it. And so some people view, for example, uh, the market cap as we know it is not exactly what you think it is, right? So market cap is just calculated by taking the price of a coin by the number of coins, whereas there's other ways to now like analyze it, like realized market cap, which is essentially the cost basis, things like that. And also, I mean, obviously, fees are more based on transaction volumes than on market cap. And so, there's different ways to look at it. I went and added the same kind of chart for fees as a percentage of transaction volume, and you get the same story there because we've had pretty consistent velocity. If anything, velocity has actually mildly declined over time, meaning that the ratio of transaction volume to market cap has gradually inched down a little bit, although it's been in a pretty consistent range. And so their view essentially is that if Bitcoin reaches, say, $1 million per coin, that the number of transactions would be higher than probably my base case, and that the fee revenue would be higher than my base case. And so we have kind of maybe different views of what partial hyper Bitcoinization looks like in terms of the fee market. And so, I think it's one of those things where there's certainly, even in my article, I have a range of outcomes. I'm not like, this is the outcome. I have like a grid that shows, for example, different levels of market capitalization or transaction volume and what different fee structures would mean in terms of overall miner revenue. And this is relevant for a few reasons, because one is we're estimating the overall size of the, kind of the total addressable market of how large the Bitcoin mining industry could get, right? So that's one thing. And then two, we're also, basically analyzing how secure or how hard to attack Bitcoin is in the long run. And so these are useful debates to have, to basically model out how fees are going to work. And there's different camps on this. I guess, from what I've seen, my views are pretty similar to Nick Carter's view on how the fee structure works. I know he's done some work on that. And so essentially, what we want to see, this is also the reason I like the Lightning Network, is because, you generally want to see scaling methods that are tied to the base chain pretty closely, right? So every time you open or close a Lightning channel, you're contributing to Bitcoin security, even though you're doing a lot of transactions, with those, smaller number of transactions. Whereas if you do something like, wrapped Bitcoin in the Ethereum network, you put it in, and then that can trade around a lot, and that's basically not contributing to security as much. And so generally you want to see scaling methods that are closer to the base chain. And so that's what we've seen so far. And so, Bitcoin is going to scale in any number of ways. There's going to be custodial scaling. There's going to be lightning scaling. There's going to be liquid scaling. There's going to be things maybe we haven't even thought of yet. And so in one way or another, those lead back to some base chain, transactions. And what you want generally over time is that base chain becomes, like a settlement layer, very, very large kind of transaction fees per movement, and then smaller transactions are extracted onto higher layers in one way or another.
Okay, cool. So the last thing I wanted to touch on with you is altcoins as inflation and declining Bitcoin dominance. And this is really about confidence in the Bitcoin network, because a lot of people don't do the work. A lot of the debates still that happen on Twitter with new people coming in, and each bull market is like an increasing number of people coming in. It's an accelerating rate. And those debates about understanding why Bitcoin is preferred to, say, Bitcoin Cash or BSV, but also why it's different to Ethereum and all these other blockchains, it becomes harder and harder debate to have, because there's so many people to have it with. And also some people just don't do the work. They don't spend the time understanding the difference between Bitcoin. So this itself is a risk. We also have Bitcoiners and Bitcoin maximalists categorized as boomers, and it's being boomer coin, and Ethereum can do everything Bitcoin can be done. There's essentially a war on narratives. I'm just going to expand a little bit here, because I've actually had this discussion with a couple of people recently, and I'm going to cover it as a show. But actually, the war on narrative is really important. And then sometimes perhaps even Bitcoiners need to consider this to ensure that we don't get kind of beaten back down by these narratives from other chains. But I guess you're talking about a confidence thing here.
Yeah. So, one of the challenges of a blockchain is that, Satoshi created digital scarcity, which is remarkable. And the kind of the one kind of workaround to that is that anyone can copy the entire code base and modify it and then make their own separate blockchain. And so that's not something we can do with precious metals, right? So there's gold, there's silver, there's platinum, there's rhodium, palladium, but there's not really more than that. We can't just make more precious metals. We only have the ones we have. Whereas with blockchains, you could make an unlimited number of them. And that, a lot of people view that as threatening Bitcoin's scarcity, because, there will only be 21 million Bitcoin. But, then there's Bitcoin Cash, and there's Ethereum, and then there's Litecoin, and there's dog money. And, now there's a bunch of different types of dog money. And so, that can diffuse the scarcity, especially because people end up not being able to understand why, maybe one unit, one blockchain is better than another in terms of security and moneyness. And the analogy that I've seen used before and that I like a lot. I used to use the social network example, but I actually think the Wikipedia example is even closer, where I could copy Wikipedia, right? You can actually download the data. And the text data is not that big. If you download the pictures, it's bigger, but it's still doable. You can download all the Wikipedia, and I could post Wikipedia on my website. And the question is, would I get anywhere near the traffic that Wikipedia gets? And of course, the answer is no. I wouldn't get anywhere near the traffic they get, and it's because I can copy all the text that's there, but I can't copy the network effect. Specifically, I cannot
Yeah.
copy the millions and millions of links around the internet pointing to the real Wikipedia, and I can't copy the active user base of people that are constantly updating Wikipedia. I can't convince the majority of them to come over and update my version instead. So mine would always be the sad, barely visited like shadow of the real Wikipedia. The same thing is true going back to the social media network example. If I make Twitter that looks like Twitter, uh, but I don't have the network effect. I don't have the developers, the users that Twitter has. So it ends up being forever this like struggle Twitter that no one uses, even though maybe I somehow copied the entire code base. It's just not the real thing. And so Bitcoin has that network effect. And now, I've talked with Elizabeth Stark on this. The Lightning Network is another enhanced to the network effect because that takes years to develop. In addition to the development, which is copyable, but the years of liquidity and nodes that make that network very usable, that takes a long time to develop. That's harder to do than a DeFi project or another blockchain. And so Bitcoin now has multiple layers of network effects built on top of it, and that so the security is higher, the development is more secure, and there's features being built on top of it. We also have, hardware. It's like there are certain hardware wallets that only cater to Bitcoin. There are certain applications that only cater to Bitcoin. In addition to any ones that cater to multiple coins, right? So we have our basically an increased kind of surrounding ecosystem, and so overall, that's what separates Bitcoin from other tokens, and is mainly why we view that one as money, and everything else is like at best an equity or at worst a scam compared to Bitcoin itself.
Yeah, it's really interesting to see what Jack Dorsey is doing with regards to Bitcoin as well, because they've talked about creating a hardware wallet. That now he's talked about creating a decentralized exchange. The work they're doing on creating open source code for Lightning development. He seems to be working very hard on this like Bitcoin only ecosystem to support what you've just said. So I find that super interesting as well.
Yeah, I'm excited to see it because he's talked about integrating Lightning wallets with Twitter.
Hmm.
He wants to have an alternative to fiat to Bitcoin on ramps based on what he said. So he wants to have a better peer-to-peer trading, and that'd be basically a defense. I think like that's one of the benefits of talking about the risks because, for example, he's clearly aware of the risk of fiat on ramps being taken down, not just in the United States but in any country. And so the better tools you have for peer-to-peer trading and ways to get into the system without going through the banks, the better. That makes the network more resilient. And so it is good that someone like that is working on those problems and has kind of a large pool of capital to potentially use to see his views come to life. And
Yeah.
so, you know, the way I view it right now is that there's only two blockchains that have serious network effects, and those are Bitcoin and Ethereum, and those are very very different, right? So one's a proof of work, security first blockchain that did not have a pre-mine, that does not have a marketing budget or a development budget, and then the other one is a smart contract platform that does have equity-like characteristics, that has a number of more security problems, that is changing over to proof of stake, which again I view that more like an equity at that point than money. And so Bitcoin doesn't have any direct competitors really in terms of what it does. The competitors like Litecoin or some of these hard forks are very very tiny compared to Bitcoin. And so the only concern really is that whenever you have a bull market in Bitcoin, and you're going to get this alt season that comes with it, where there's this flourishing of new projects, and that pulls in all this capital, right? So literally, Dogecoin reached like a $90 billion market capitalization, and if you look at Robinhood's filings, I mean, Dogecoin was like a very meaningful percentage of their revenue, Dogecoin trading fees, and they're literally people like they're in this walled garden because you can't pull your coins out. They don't know that the whole way the nodes work. They don't understand how what makes Dogecoin technically different than Bitcoin. They think it's kind of the same code with a different brand, and that's really not how it works. They don't understand the security differences, and it's so far historically it's been through bear markets that the differences get understood. And so during the bull markets, basically this ends up being a real risk because all these other supply exists. People flood into that, and that eventually exhausts buyer demand because all the money that could otherwise have just gone into Bitcoin gets spread out into any number of projects until there's just tons of malinvestment and no one's willing to buy anymore. The whole thing kind of rolls over, and then we go through a long correction phase and we separate the wheat from the chaff. And so, in some ways, Bitcoin and other cryptos have done this to gold, where if Bitcoin was never invented, none of these exist. Gold would probably be somewhat higher today because there's a certain percentage of people that would have bought gold that for lack of other alternatives. But because they have these alternatives, they buy those instead of gold. And so the same
Mhm.
thing can happen with Bitcoin, at least temporarily, where money that would all flow into Bitcoin instead flows into, say, rock JPEGs or dog money, and so that at least that's that kind of the bull market peaks out at a lower phase than it otherwise could, and then goes through this consolidation as we clear out these projects that and it's hard to say which ones will necessarily go all the way to zero versus which ones will have some sort of residual value, but it's that kind of at least slows down adoption to some extent.
Yeah. Well, it's really interesting going through all this because Bitcoin's always been under attack. It's always had its threats, and it still does today. But we are in a very good position, and it feels like most of the things we've covered today, I think we've covered them fairly. But everything is just kind of like it's kind of like continue as you are. Continue supporting developers. Continue ensuring you manage good personal security. Continue focusing on Bitcoin and teaching people why Bitcoin is more important than altcoins, and a certain amount of like wait and see with regard to things like quantum and secure and the fee market. So I think we've covered it fairly, but I feel very confident in Bitcoin's survivability. Certainly, the next 10, 20 years, I feel very confident. I assume you're very similar.
I agree. I think it's an exceptionally well-designed protocol.
Mm.
Part of my decision to go from neutral to bullish on it back in early 2020 was that I view the network effect as having achieved kind of escape velocity, where the probability of permanent loss to any other attempt really was low. And so I view Bitcoin as the best chance we have in order to have what like people have pointed out. I mean, Henry Ford talked about a currency based on energy 100
Mm.
years ago. And this is the best shot we have, I think, to come to this viewpoint happening. I think that's a really powerful idea. It's funny, people are worried about Bitcoin and the environment. Literally as someone with electrical engineering background, I want Bitcoin to use more energy because it uses energy in such a useful way that it can actually improve a lot of things.
Yeah.
And so I'm very bullish on Bitcoin, and so that's one of the reasons I like to focus on it both positively and discuss the risks. So, because I want people to understand them. I want people to see, the difference between Bitcoin and other protocols, what makes Bitcoin unique, and just people can continue to support this. There's other risks as well, like if I think you've talked about this. If the El Salvador experiment doesn't go well,
Mm.
even if for reasons unrelated to Bitcoin, that could again slow down adoption. Other countries could get into that maybe less than they would have if it's a wild success. And so there are any number of things that can affect the speed of Bitcoin's adoption. But in most cases, blocks will still be made. Right. So as long as the security model is intact, and so far it's done that for 13 years almost, um, it'll just keep making new blocks. And it's a lot of the risks around it are how we treat it. Right. So if we're emotional or we're leveraged or things like that, that we can get wrecked by these things, whereas Bitcoin itself is actually really resilient.
Yeah. Well, that's a great way to end it. It really is. Before we go, just a quick question: how much have you looked at NFTs? Like, have you deep dived on them? I haven't. I can't remember if you have.
So I touched on them in my research, and my overall view is it's certainly an interesting technology, right? Basically, it's the way I've described it is essentially you're getting a signed copy of something. And so I certainly understand collectibles to a degree. I mean, I have Magic cards, for example. When I was a kid, I had Pokemon cards. I mean, you can have a silly, like a piece of cardboard can be worth like $100,000, because we kind of agree that there's some sort of rarity to it. And so NFTs are kind of like that, where you have a piece of art. It's kind of, you know, that one is almost like quote unquote signed because it's kind of locked onto the blockchain. But of course, the risk there is, you know, there's a flood of new NFTs coming to market until they saturate demand. It's like, oh, you like rocks and punks. Well, here's tulips. Literally, there's tulip ones. You say, here's Lambos, here's penguins, here's apes, here's rabbits. Basically, we're gonna exhaust this whole thing, and we're going to get malinvestment. And so one of the theses for people selecting the old ones is say, well, these are 2017 ones, these are the originals, so you can't, they're going to be the ones that hold value. But if you look at their prices relative to, say, Michael Jordan rookie cards, they're higher. And it's like, you have to. It's one of those things where you have to be. I'm not like an art critic, so I don't want to say like I think this NFTs worth this. It's just I view the space as like 99% malinvestment, 1% interesting technology. Um, I've seen, the guys at Blockworks just had like a episode out, and they kind of characterized that every cycle kind of has an interesting idea that ends up being all crap, but then it kind of plants the seed for the next
That's
cycle.
right.
Yeah, so like you had the ICO boom, and then years later you got DeFi, and there's actually something kind of fascinating there, right? So you kind of had the seeds of it planted earlier, and then now you have NFTs, and we have like multi-million dollar rock pictures, and it's like, well, NFTs are kind of an interesting phenomenon. We'll see where people and technology take this. I know the guys that work on Liquid, for example, I think they put a
Yeah, the
movie ticket out.
tickets.
So there
Mm.
is, I think there's interesting kind of long-term ways to play this. There are such things as luxury goods, or people want to display some sort of flex in terms of I have the say the rare penguin, whatever the case may be. Like someone can show, like, I'm not saying I do, I'm saying someone can basically show that they own something. But I view that there's a very high probability of malinvestment in the space. You're also tied to the security of the blockchain. And so, for example, there are crypto punks on the Solana blockchain that look, they're like the same ones in most cases. Like most of that is overlapped. There's like an alien punk, and those are worth way, way, way less than the Ethereum ones. That's because they don't have as much confidence that the blockchain is going to be around for a very long time, and it's going to catch on and become the dominant, say, smart contract blockchain. And so, let's say you buy an NFT, and let's say Ethereum, for whatever reason, doesn't work out 5 years from now. The fact that your JPEG is like signed on that blockchain doesn't mean much, right? Because
Mm.
so you're betting both on the underlying blockchain and that NFT on that blockchain will be viewed valuable years from now. So yeah, so I view pretty much the whole space as rather speculative mania at the moment, where people are making money, but I don't view it as kind of durable value.
I think that ticket thing's super interesting because any technology which cuts out a middleman and saves people money is super interesting. And if you think with regards to concert tickets or sports tickets, I almost always buy these days off the secondary market. But these websites that resell the tickets always have considerable fees. Now, if I'm going to be buying, say, 2 tickets I'm going to the boxing in Vegas, and say the tickets are $500 each, you can end up spending 100, 150 in fees for each ticket. If you could create some kind of like a decentralized exchange for these tickets, which are NFTs, that's kind of interesting because I can sell my ticket to you. There's no middleman in between that. So that's going to reduce the cost and create a more efficient market for these tickets. So I do find that interesting. I know some people will be listening going, oh, you only like it because it's on Bitcoin. Actually, I don't care with regards to tickets. I wouldn't care if it's on Ethereum because it doesn't matter with Ethereum. The network has some long-term issues. If I could buy a ticket off you now and I'm going in a few weeks, it's kind of like low risk. But I do see that as kind of interesting.
Yeah, there's also an argument where, right now, if an artist creates a painting and then sells it, it's probably not going to sell for a ton. And then let's say years later, they're well known, and then that person sells that painting to someone else for 100 times the cost. That initial artist doesn't get any of that extra bump up in price. Whereas you can, for example, have a programmed NFT where every time that is sold, the artist gets a cut. And so it's one of those theoretical kind of neat ways you could power musicians, you could empower artists of various types, but it comes down to whether or not we're too early or if we're on the wrong blockchain. and if we're doing it for the right reasons of say interesting technology versus speculation. And so it's like one of those things in the dot-com bubble. There was tons of malinvestment, right? There was
Hmm.
pets.com. There was things that had no business being at the valuations they were at. Some of them took 20 years to recover. All right, but there were things like Amazon or Microsoft that eventually did recover and go back to new all-time highs because there was real technology there, or
Yeah.
real value there. And so I think with these kind of speculative manias, there's kind of a glimpse of something useful, but that people are distracted and unable to determine what is long-term value, what is money, what is secure. And over time, we right now we always are looking through, say, like a dirty window. We can't see perfectly clearly through it, and then years of in hindsight, through bear markets and kind of time sorting this out, we separate the wheat from the chaff and see
Hmm.
which things actually had value, which things were built on sand rather than granite.
Perfect. All right, Lim. I love talking to you. Awesome as ever. I guess I'll see you in a month.
Yep,
Appreciate you
sounds
coming
good.
on and covering this.
Bye.